Let me record the session. All right, so we're gonna start our entry model. So the basic thing is our entry model is from 10. So you need to change your time to you can see the UTC -4 New York time. So our entry model will be on New York time, UTC -4. So I'll be showing you the time on UTC -4. So in UTC -4 New York time from 10. So this is 10 a.m. Can you guys see my screen? Uh, so from 10 a.m. to 11 a.m., that will be our entry model. So imagine this is 10 a.m. and this one is 11 a.m. Yeah. So the basic thing is the price. Before the past thing, the price moves like this. Yeah, the price moves like this, and when it comes to the trading model, that at the time of the trading model, the price creates a new higher high and comes down and creates a new higher high. And what happens is it comes down and creates a market structure shift in the time period. So at this time you don't trade nothing, but at the time of 10 a.m. when the 10 a.m. start, you want to see a market structure shift with the displacement. So displacement is like when you have a strong candle with strong bearish pressure or strong bullish pressure. I'll show you the charts, but before you need just understand the things. So the market structure shift is a, if you can see right there. So the price was going like this, creating lower highs, lower higher highs, lower higher highs, lower highs. And as soon as it reached the trading time, it creates a higher high and a lower low. So when it does this, it's a market structure shift. And what happens is after that is the price comes back to this the displacement right here in this. See this is the displacement, and the price comes back to the displacement and trades down. So trades down like this. So our entry will be from here, and our stop loss will be right above the high high, like 1 pip above the high high. So this will be our entry model. So in this trading period, there's so many things happen inside the trading period. So it's like, so why the price comes here is because there will be an FEG here. The FEG is called fair value gap. So there will be a fair value gap here. That's why the price comes and retests the fair value gap and fills the fair value gap and trades down. So that's our entry model and our trade. So preferably we'll take 1:2 RR or 1:1 RR. So if you're a beginner, take 1:2 RR or 1:1 RR. So I know you don't understand what I'm saying now, all those things. So, but I'll show you the charts and you will understand. So leave all this. first we will study some basic things. So if there's a candle like this and a candle like this, and a candle like this, and these are the wicks of the candle. So these are the wicks of the candle. So this pattern is called swing high or swing low. So this pattern is called swing low. So if it creates the opposite, uh, like this, this is called the swing high. So why is it called the swing low and swing high? Is because there's a candle with the wick here, and in the left and right there are candle with wicks low or lesser than the previous, the the wick in the middle. So get inside here. Yep. So it's like two lower candles on the left and right, and a higher with a more wick on the middle, in the middle candle here, right here. So you see the pattern. So the thing is, if the candle is like this, and creates a wick here like this, and like this, and like this is not a swing low, because you can see the middle wick is now lower than the previous wick in the left side. So this is invalid. So this is not a swing low. The same thing applies to here. If the candle is like this, like this, like this, but the wicks are like this, and the smaller wick and a higher wick like this. This is invalid. This is not a swing high. We need a swing high to be like this. A wick here and a smaller wick left and right, but it does not break the higher wick. So did you guys understand this part that I teach you now? If you understand, type in the chat. Or or if you need further explanations, I'll tell you. All right, so you say, oh, everyone says boy, so let's remove all these things. So the thing is, so when so it create so how this swing high and swing low forms is like this. There's a higher high, higher low, high high, higher low, and all this. Just the noise. Don't worry about all this. And in our trading time of 10 a.m. to 11 a.m., it creates a displacement and a market structure shape. So if you can see here, this is for the swing low forms. Oh, so this is for the swing low forms right here. This is for the swing low forms. So we need a break of the swing low and the price retrace to the fair value. Right. So now I will teach you the fair value gap right here, the FEG. Before that, I'll show you some examples here. Let's go to 10 and 11 a.m. So it's 31 and yeah. So this is our entry model. You can see this. This is the swing high right here. See, there's a wick, a lower wick in the left and lower wick in the right. So this is the swing high. If this is the opposite, there will be a swing low. So this is the swing low, this is a swing low, and this is a swing low, this is a swing high, swing high, swing low. So all these are swing highs and swing lows. So, and you see, so these are the swing highs and swing lows. Now I'll teach you the fair value. So that's more or less. So the fair value gap is when a candle. So this one is a candle. There's a different candle. And another candle. These all are, imagine these all are bearish candles. Yeah, all these are bearish candles. So and creates a, now there's a bullish candle here. And a candle with high pressure and displacement forms, which takes out all these three candles and creates a market structure shift in market structure. So imagine the market was going like this, all the way like this down, and comes back here. So here's the swing high, and this displacement candle takes out the swing high. So, and it creates one more candle after that. With the wick, so I'll draw you some wicks also here. It's a wick, sorry for that wick. Wick. That's a wick. Yeah. And this part right here, where the wicks are not filled in, is the fair value gap, FEG. So the thing is, FEG here. So why is this the FEG? So there was bearish candles, 3 bearish candles, and 3 bullish candles. The 3 is just number, don't, like I just said 3 for the sake of the picture. So there were bearish candles and a bullish candle and one more bullish candle with the displacement with high strong buying pressure, and creates one more candle, a bullish candle or a bearish candle, doesn't matter as long as it's after the breakout. So creates a space where the price didn't give opportunity for the sellers. So the price was moving like this, the price moving like this, and went straight to here to buy, but price creates a gap, but the gap is not filled in. So what the price does is always the market is price comes back to the gap to fill in this gap, these two gaps right here. So how to calculate the gap? So it's like one candle, two candles, three candles, so 1, 2, 3, and the middle of 1, 2, 3 there will be a fair value gap. That's how we calculate this thingy. So the market didn't give opportunity for the sellers. So what happens is then after the 2 or 3 candles to the upside, a bearish candle comes in to the fair value gap. Bearish candle like this comes in and fills the fair value gap. So the market that fulfilled the thing to fill this fair value gap right here, you can see fair value gap is between these two wicks. Market fills the fair value gap, yeah, and we take our entry from here. Stop loss below target. So why is the candle coming to fill the fair value gap is because the price doesn't give opportunity for the sellers, and it ran, and the buyers ran all the way and took out this swing highs, but didn't give opportunity to the sellers. So the price, every time the price in the market, every time, this is the imbalance right here, imbalance in the market. So price come down to rebalance and goes back. That's what happens. I'll show you in the charts now. So let's see. You can see right here. So this is the swing high right here. That's a swing high. Price breaks this swing high with this green candle right here. But what the price leaves a fair value gap right here. You see the fair value gap. There's a wick here and the wick here, and this is the FVG right here. 1, 2, 3, and the middle of that. It doesn't give opportunity to the sellers while going up, while going and break the swing high. So it came back. All right. So there are 10 more minutes for the session. So if the session stops, I'll give you one more link to the new session. So just start joining from the. So the price came back to the fair value gap, and you see the price runs. This is the FPGA. So I'll tell you once more. Price creates the bearish move, and suddenly the creates a swing high right here, and the swing high is taken out by the bearish up close candle. No, the bullish up close candle, sorry. By the swing high is taken by the bullish candles, and the bullish candles creates a space right here. It's called the fair value gap. Means fair value gaps means the name it says fair value, so it doesn't give the price has not given opportunity to the buyers or the sellers. Yeah. So the sellers comes down, the sellers comes down, fills the fair value gap. You see, when it goes all the way in, fills the fair value gap. Our entry will be here, long, preferably here. We don't take our entry from here. We trade in the fair value gap right here and stop loss here and take profit all the way to the first imbalance. So the first imbalance is here. Can you see the first imbalance? So the price has not given opportunity to the buyers here when it's coming down. The price here breaks the structure, didn't give the opportunity for the buyers to come up and come down. So we target go straight to our first imbalance right here. So this is the where we target and we take profit. And that's a 1:2 ratio here. So if you guys understand what's fair value gap, type in the chat that I understood fair value gaps, or if I need to explain more about the thing. How uh, did you guys understand the concept of fair value gaps? Uh, or should I unmute everyone so people can tell? I'll unmute everyone. Or you can unmute your mic and say if you understand. Yeah. Yeah, I will make a video on it. So I'll make it. So this is more like I'm going to rush. I have only 1 hour of the session, so this topic is like a vast majority. You know, the ICT is like a university, a college, a vast majority of a topic. For this thing to understand, it's really hard to understand all this. So I'll make videos every day or and post in the Discord channel. So now you understand the fair value gap. I think you understand the fair. Let's go to the now. Let's talk about market structure shifts. Yeah. All right. So this is our trading window right here. And the price comes like this, the normal thing that price does. So this is called, so where is it? This thing, this displacement that I showed you before is the market structure shift. It breaks the swing low right here. This is the swing low. Breaks the swing low right here. Creates a market structure shift. Market structure shift. This is the market structure shift. And there will be a fair value gap right here. So you always, when you come to this trading window, always you need a market structure shift which comes like this. This takes out the swing low like this with a displacement, takes out the swing low with the displacement, which creates a market structure shift, and the displacement leaves a fair value gap where the price comes back and you will and your this will be your entry. So if you think about, like, you guys have heard of like retest, the market comes and retests and goes back, like double bottom, double top, all these things. So all these things are working on the basis of smart money concept here. So this is what happening on all these things. So market structure shift, displacement comes back to a fair value gap, trades back down. So this is the market structure shift. So I'll show you some market structure shifts. Let's see. Let's go to 5 minutes here. So you can see the price was bearish, coming down, price bearish, and suddenly right here creates a market structure shift. It shifts the market. So market structure shift is an indicator for the reverse movement of the market. So if the market wasn't bearish, the market was bearish for a long time, and if the market shifts like this and comes back, the market will change the direction and you will see bullish prices like this. And this is the market structure shift. And there will be a fair value gap right here. So the market structure shift is an indicator to the reversal of the market. Is that indicator to the reversal of the market? So if you see a market structure shift, you can predict, like, there's a high probability the market is going to reverse. So there's only 1 minute left to session. I'll give you another link in the Discord. So if you guys understood the market structure shift, just type yes and create a new link.